The next stage of my journey was marked by theory finally giving way to practice. All the basic rules were already in place, the strategy was clear, and the risks had been calculated. But it was at this point that it became clear. Real growth begins when you know how to apply your knowledge in a live market, where every situation is different from the last. One of the most memorable trades took place on the euro to US dollar currency pair following the release of US inflation data. Most expected a sharp strengthening of the dollar, and the first few minutes looked exactly like that. The price plunged impulsively, gathering liquidity near the nearest support levels. But then the move was quickly bought out, and the market returned to the range. For me, this was an important signal. The strong news failed to gain traction. I waited for the price to consolidate above the retracement level and entered a long position with a short stop loss. The trade lasted several hours and demonstrated how important it is to look not only at the news but also at the price reaction. Another interesting example was with gold. For several days, the instrument had been trading within a narrow range, with false breakouts in both directions. Many tried to trade within this uncertainty, but I preferred to wait for a breakout. When the price finally broke through the upper boundary and volumes began to rise, it became clear that the accumulation phase had ended. I entered after the level was retested, without chasing the move. It wasn't the quickest trade, but it was one of the cleanest in terms of structure. One situation that particularly stands out in the stock market involved a major technology company following the release of its financial results. The figures were strong, but the opening price fell. To a novice, this might have looked like weakness, but I understood that the market often takes profits first and only then establishes a direction. After the price stabilized and demand returned, I opened a position and held it for several days. It is precisely moments like these that serve as a reminder. News headlines and actual price movements are not one and the same. These trades share one principle: patience. None of them were opened in the first second of the impulse. On the contrary, the best results came when I allowed the market to reveal its intention, rather than trying to predict it in advance. With experience, I have become even more relaxed about missed moves. Sometimes the market moves on without me, and that used to annoy me. Now I understand. A missed opportunity is not the same as a loss. It is far more dangerous to enter a weak trade simply out of fear of missing out. My attitude towards profitable streaks has also changed, whereas before, after a few successful trades, I'd want to increase my position size and capitalize on the momentum. Now I do the opposite. I stick to my usual rhythm. An emotional high is just as dangerous as the disappointment that follows losses. These days, trading feels more and more like a craft to me. No dramatic emotions, no attempts to prove anything to the market. There's a process, there are statistics, there's discipline. And spectacular trades are not the goal, but the natural consequence of proper preparation. And the further I go, the more I realize a simple truth. Great results are not built on rare, perfect entries, but on a multitude of calm, high-quality decisions made at the right